Good to have you with us here on The Open. And obviously this week we are going to be watching very closely what happens in Washington with U.S. President Donald Trump on the verge of hitting Canada and Mexico with 25% tariffs. And the possibility of doubling the levy on China. Increasingly, we've seen the jitters playing out in the stock market. We just had a very volatile February period. For more on how you should be thinking about the tariff threat as an investor, let's get some insight and analysis from Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners at Raymond James. Brianne, nice to have you with us. How have you been thinking about the tariff worries?
Yeah, thanks for having me as always, John. There's been definitely a lot of market noise out there. I think over the past 2 weeks, we've seen a lot of volatility for investors, especially coming off a little bit more muted volatility the past 2 years. And February really was a reminder that market swings can hit fast. We saw the S&P 500 shed 1% last week alone and drop 1.4% in the month of February. So that gave much of its January gains. NASDAQ lost its progress, really dipped into that red in the year. And TSX has held up, unexpectedly well, but really showing some resilience, mainly due to the materials sector that has really helped to prop it up. So, really what's behind the sell-off, no doubt, is really Trump's new tariffs, spending cuts from the DOGE, and really weakening U.S. economic data that has started to come out. So the one thing that markets hate more than bad news is uncertainty, and that is really what just drives volatility. And right now we're seeing a little bit of both. So I think after we've seen, back-to-back double digits in the U.S. stock market, it's a reminder to investors that volatility is back and it's normal. And since even going back to 1928, in an average year in the markets, we see at least one 10% correction. So currently the S&P 500 is really only down 4% off its peak. Yeah, no,
it's a great point. We were saying that earlier in the program. Look, on the one hand, in a worst case scenario, a lot of economists have said don't be surprised to see a very serious recession for Canada, depending on how the tariff story plays out. On the other hand, I was making the point earlier that there are a lot of stocks within the TSX that might have some shelter, if you will, from tariffs. Maybe not over the long term if sentiment just completely sours, and who knows, but in the short term for sure. So how are you thinking about TSX stocks in the face of tariffs? Like, are there examples of companies that might be in a better position than others?
Yeah, for us, from a Canadian perspective, which sectors will be hit the most? I think you'll see, energy, even with the 10% they're talking about. I think tariffs on Canadian crude oil and refined products could hit revenues hard. There are some that are mainly like Enbridge, I think is going to be fine, but there are some other energy sectors in the space. Industrials, automotives, manufacturing, again, any that have significant cross-border trade exposure, this definitely makes this sector a little bit more vulnerable. And we are starting to see, some companies relocating their headquarters potentially to the U.S. to avoid tariffs on their U.S. revenues, like TFII. Some Canadian, exporters will definitely feel a little bit more pressured. In the auto parts industry, think of like Magna International, Linamar, in the lumber or wood, West Fraser timber, and then energy. I think it is the energy producer. So volumes, are steady short term, but pricing spreads could definitely get under pressure, and that would be, a net negative to them. So again, all things that we're watching closely. I think some relative winners that we expect to see, especially out of the U.S., would be Waste Connections, out of Canada still, that do have significant U.S. revenue and assets. Waste Connections, Shopify continue to do well. Gildan Activewear, Couche-Tard, Brookfield Corporation, and Fortis. And obviously, I think still continuing, I know you mentioned earlier gold, and that's a big topic, but still the gold miners with, Canadian-Mexican production there. So if you think of Alamos Gold, I think those are some of the stocks that will continue to be a little bit more resilient if these tariffs do go through.
Yeah, it's interesting and complicated, quite frankly, because most businesses that have big success are built for the global economy, right? So, they're extending beyond the Canadian border, whether that's to the U.S. border. They've got some international markets, so this is that nice opportunity to start looking at where these different Canadian domiciled businesses actually make their money. But even, it was interesting, we had a conversation last week with the CEO of Jameson Wellness, who said, yes, we have a big U.S. and Canadian business, but we have facilities respectively in both countries, and so the products are distributed from those respective markets without necessarily crossing the border. So I guess we'll only know with time. Would you say overall for 2025, like you're still putting money to work in the stock market in the face of this uncertainty?
Yeah, I think we have a little bit of cash on the sidelines right now. We have about 8 to 10% cash just ahead of some of this volatility, and we do expect the volatility to continue. I think the first half of the year is definitely going to be a lot more volatile than maybe investors have been used to. But all things considered, I think it's just about navigating the uncertainty this year. So I think, the global economic landscape is at a critical juncture, right? With markets facing heightened volatility, shifting sector leadership, we're seeing a lot more broadening out, which does allow us to pick up some stocks as active managers at some discounts, or when we do see favorable entry points and some favorable valuations. There's still going to be ongoing geopolitical uncertainty that I don't think is going anywhere. And obviously these escalating trade tensions are going to be ongoing. It's just might continue to be delayed. Again, it's a little bit wait and see. So for us, we still see investors that have been the most risk on since 2010. So for us, that is telling us to be a little cautious right now, but we are still deploying capital in tranches, being a little bit patient and monitoring corporate guidance, right? So we do think that we're watching interest rate policies and the direction. Based on the U.S. economic data, we might actually see some cuts come a little bit earlier than that June, July as initially proposed. But again, that's a little bit wait and see. We will get some more clarity at the end of this week. I think positioning a little bit more defensive. So again, healthcare, we are overweight sector and I have been saying that for a while. We do see that as a leader, especially in earnings growth for 2025. And I think a diversified portfolio is going to be the winner for 2025.
All right. Thanks very much.